Welcome to My Money Mindset podcast, where we explore how a healthy mindset is the foundation for financial success. Each week, we delve into mindset hacks and practical strategies to help you enhance your income, help you make more appropriate investments for yourself, and to improve your overall financial well-being. Join us on this journey to transform your financial future by transforming your mindset. Please note that the information provided on this podcast is for general information purposes only and does not constitute as personal, financial or health advice. It has been prepared without considering your individual objectives, financial situation or life needs. Before making any financial or health decisions, you should consult with a qualified professional or financial advisor to ensure the information aligns with your specific circumstances. So let's begin and enjoy this journey as each episode teaches us on how to improve our overall mindset that it overall improves our financial success. In today's episode, I'm going to delve into a little bit of what's happening in the market with investment properties and in what's happening in common investors of Australia. What to do with their money. It seems like the property market has sort of let go of, we've let go of a lot of trust within the market. A lot of people are losing money or not making money, or there's been a lot of goalpost changes simply because, let's say, for instance, if you've had short-term stay investments, as in short-term holiday stay investments, now the taxes that are implemented upon these holiday homes, land tax, especially in Victoria, just certain things that have really placed a heavy emphasis upon and burden upon the expenses for the investors with these investment properties. And what we're not seeing is a capital return or a great capital return or even sometimes a loss, right? So what tends to happen in this environment, it does not last forever, but it tends to last a long time in an investor's mind, because an investor's mind, don't forget, is always looking for ROI or return on investment. And that return on investment in your mind, realistically, we like to think that it should be occurring every minute of the day type of thing. But that being said, what we tend to do as investors or property investors is to think, okay, if we're playing the long-term game, we're trusting within the property market that we're going to get a capital return. But over the short term, what tends to creep in our minds are the certain things of, well, okay, I can wait a long time, but I also can sell up and see what other opportunities are out there. Now, most of the time, within property investors, they tend to like property simply because of the security. You can touch it, you can feel it, you can rent it out. People are always going to need houses or commercial properties to rent out and so on and so forth. So we tend in our mind to feel that it's a security. I know for myself, and I also dabble a little bit with the share market as well, but I tend to feel as though property is always quite secure in my mind. Am I right or wrong? Probably doesn't matter, so long as the return on investment is there for me. And I know that a lot of people that tend to sway towards property, whether it be commercial property, retail, mixed zone, or even residential, tend to like it simply because you can actually touch it, feel it, drive past it, rent it out. It's never going to go down per se in a sense unless you buy it for an overestimated sort of cost and all that sort of thing, right? So as the population grows, so too does housing, and people need somewhere to live. Whereas on the share market, even though the returns are really fantastic, sometimes better, as a property investor, we always say, well, just in case that company goes under or doesn't perform as well, if we sell it tomorrow, we actually are left with, not much. So, and I always feel that when I speak to my clients that are investors, they tend to prefer prefer property over shares simply because of those particular reasons that I just mentioned. And that to me sounds like an investor that really doesn't want to get too heavily involved in the share market, the trading side of things. Some people do. Some people have the time to do that. Whereas I feel as though most of my clients are all steered or orientated, and it's probably because like minds think alike. So I'll probably attract those type of clients that prefer property or a mixed bag, right? Because at the end of the day, when I'm assessing or mentoring on finance or anything like that, I have a look at the overall assets and liabilities, which I did an episode on assets and liabilities and what it all means. But shares are fantastic. Look, there are so many other ways to invest, but getting back on track towards what an investor in today's market, which seems to be sitting relatively still for property investors, we tend to sort of start to think, is there anything else we can do with our money? But if I sell my property, take the money out of it and put it into something else, will I get a better rate of return? And when can I get back on the property market, or will I get back on the property market? So that's just in the mind. A lot of people don't actually come up with these ideas to discuss them, because quite often this discussion will require at least 7 months, 8 months, 9 months of a decision-making process, because it's such a big process, right? Because we toy with the idea of thinking, if we sell, what are we going to get for it? If we don't sell, how much money are we actually losing, as in opportunity costs, which also was mentioned in another episode. Opportunity costs are the costs that are implemented or are felt when you actually don't invest in something, right? So, for instance, if there's a house that I could potentially buy for $1 million, I know it's going to be worth 1.1 in 1 year time, and I don't buy it, that's an opportunity cost of maybe 100 grand minus the costs of buying it, type of thing. It is a simpleton term, right? But opportunity cost is that what, if you missed out on that opportunity, how much does it cost you? So for a property investor, if they don't sell this property that they feel is that going up, and let's do an example. So let's go back with the $1 million property as an example. It hasn't really grown that much. It's actually getting rented out now. It's not bad. It's round about breaking even. Let's call it the rent I'm receiving is around about 35,000. The interest or the total costs on this property around 35,000. It's breaking even. Capital gains, not really happening, right? Let's say it's not growing, or the suburb isn't going great guns. It's probably going 3%, 4% maybe. That's not bad. But let's say it's not. And let's say in my mind as an investor, I'm thinking, I really could be doing something more, but what do I go for around the 3 to 4% that actually doesn't take the burden upon land tax and all this sort of stuff, right? All the costs involved with property investing and the property costs. Not a lot. There's swings and roundabouts. There are fund managers that often around the 8%, or term deposit that's around the, I think, gee whiz, it floats all the time. It depends on the bank, but between 4-5% thereabouts. But then, you put your cash in there. We've also got a warrant that cash over inflation will lose a lot of sort of buying power in the future. So these are always the problems as an investor, what they think. And then at the end of the day, they turn up and say, I'll just leave the property. It's not really costing much, or it may be costing a little bit. Let's say there's a loss of $5,000. It's not bad because I know the capital gains are going to increase eventually. And we set and forget, right? What this episode is about is probably not to solve your problems all of a sudden and say, well, buy, sell, or keep, or rent, or put the rent up, or do a makeover and increase the rent, or put it into a short stay, whatever it might be. There's so many options we can do with property. Put it, whatever it could be, right? Do whatever you want with it as an investment property, but it's not to work out whether you should sell it or buy it in this episode. What this is actually doing, what I wanted to sort of explain is this property, you've somewhat got an expectation on it, right? So your expectations when you first bought it are probably not quite as accurate as the reality of what's happening today, or it hasn't happened, or it may have overperformed, which is fantastic. And you probably wouldn't even, you'd be fast tracking this episode. But that being said, it's an interesting fact to understand that if you are a property investor, and if you are a sort of person, the investor that, look, doesn't mind sitting back at a midterm investment range and sort of tends to like the security of a property, but doesn't want to dabble in other things like Bitcoin or whatever, they're not interested, or they don't care to know about it. They're happy to just prod along. But they wouldn't also, if the opportunity came where they could put their hand up and say, I wouldn't mind a bit better return on my money, well then you could potentially be a property investor and also another investor in somewhere else, right? So what I mean by that, if you've got $1 million property and I draw equity out on it and I'm paying a 6% interest rate or thereabouts on it, and I owe 500,000. So let's make that $1 million home example before we're talking about. Have a $500,000 loan on it. I'm paying about 6%. So roughly interest is costing me about 30. Yeah. Rates, that sort of thing. And I say, look, I'm not going to sell it. It's not really going anywhere. I do believe it's going to increase over time. The common thing is properties always increase between a double every 7 to 10 years, relatively speaking, depending on where it is, of course. But that's what generally properties have done. I'm going to believe in that, and I'm going to stick to my guns and just stay on the straight and narrow. But what I wouldn't mind looking at is drawing upon equity out of my investment property or my property and refinancing and getting cash out up to 80%. Up to 80% will enable me to avoid paying lender's mortgage insurance on the loan. So on this $1 million loan, it values up to about valuation values up to $1 million at 80% is 800,000. We've got a loan of 500, and we say we can potentially pull out, if we wanted to, 300,000 cash out, depending on the bank, of course. So you've got to speak to your broker about this. Get that 300,000 and then invest it elsewhere. Guess what, guys? There is other places that you can get higher rates on your dollar. So long as that rate that you're achieving back is higher than the costs of drawing that money out. So for instance, that cost in this example would be the 6% interest rate, certain other bank fees or whatever there may be, holding fees. And then you definitely want to make sure that you're getting a healthy rate of return. There are other investments that do allow you to invest in property. There's quite a few of them actually going around. There's so many ways that this is done that us as property investors or investors that prefer property are enabled to actually invest in it and still have the security of having that property within our grasp and having a first mortgage security on it. So what that actually means is you draw your money out, you get the cash out, you refinance obviously to a better rate, call it 5.8 or something like that, if you can, right? If you can't, then obviously speak to your broker to be able to look at doing that. But the cash out that you're drawing out upon your investment property up to the 80% mark, just to minimise the cost of LMI, can be invested into things property related without having to get into shares and actually getting a massive rate of return on these. Now, there's so many of these investments that people can actually get involved in and roll their sleeves up and get onto it. Now, the reason for this episode is to make people aware that this is possible. The fact that you can get better returns upon your property at the moment with drawing the cash out or selling it and getting money out of your property, these are achievable. You just need to know who to talk to and where to inquire and the guidance and all that type of thing in order to do so. Unfortunately, there is no rule book out there, or there are many marketing schemes that are fully you know, they're not there to really entice you. They're there to make a lot of money. And unfortunately, unless you know where these investments are and what they're doing and so on and so forth, you'll never know. But most of the time, the people that are marketing these things or putting them up to say, hey, invest here, invest here, guys, be really careful about where you put your money, especially in this day and age where you're literally one tap of the button and it can be gone forever. Don't do it. I had an episode that I did on cybersecurity, and I will always emphasize really, 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 really trust, even if it's for $10,000, $1. Do not send it online or for an investment scheme that you see pops up or anything like that. If you're going to ever invest or anything, you must know and you must do all your due diligence. You must have all your professionals look at it before you pass the money over. I cannot emphasize that enough, and I will stand my ground. So many times, even in this day and age, professionals go, no, that'll be okay. We do it every day. Yeah, that's fine. But for the individual that saved that money and has got that money, every dollar they've earned, it's too risky to just pass that money over. So once again, because you're starting to look for these investments where you can get a better rate of return, some returns are up to 20, 25%, that sort of thing. Are they too good to be true? Sometimes. But if you know who you're talking to and you trust the person that are demonstrating this, well then, once you start to learn the opportunities there, I don't mean take the opportunity, but start to learn how that investment works. So the next step is understand. So step one was to identify you do have equity or you can have equity. Do you want to sell? Do you not want to sell? And then work out if you had the opportunity that you could get a rate of return of 9%, 10%, 15%, 20%, 25%, where to find these investment opportunities other than selling your property or replacing that investment upon the property. So you sell your property and then you do what I'm saying with the next step, stage two, to do with this money, right? So these investments are all property backed. So, but once again, I get in the way and I say, before you go ahead and look at the rate on return on these things, so for instance, you see this beautiful rate of return of 15%, property backed, no problem, everything stacks up, you send it to your solicitor, send it to one or two solicitors, I would, get two opinions on it, embrace those opinions, really pressure test those opinions, find out what their opinion is on it, talk to your accountant or accountants, talk to financial planners, really run these investment opportunities through all your professionals before you even consider. And then even before you go to pass the money over, make sure that you have done your due diligence on the people that are actually organising these investments. Now, as a savvy investor, as a savvy, let's call it investor that understands the way legal things do work and the way transitions and transactions work, you would have to be really, really on it to make sure that these investments are going to give you this return. Now, it all sounds like I'm trying to push you away from it. I'm not. I'm actually encouraging you to learn about it. Not to actually invest in it yet, but actually learn about it before you do go investing on something like that. Because when you learn, you then open your mind and your horizons in knowledge and thoughts and processes that you do your due diligence upon these things. Just don't look at the rate of return and get starry-eyed because of it and go, gee whiz, I'm going to make a real lot of money over this, so I'm going to make sure that I'll take this opportunity because it may not be ever there again and blah, blah, blah. Do not invest in it if you do not understand it, or you do understand it, but you want to learn more about it. And how much do you want to learn, Mark? Someone will ask. You know, this opportunity is there. It's saying to me 13%, 14% rate on return, gross rate on return, net rate on return. It's got all the IM. It's got all the information. This is a winner. Why shouldn't I invest in it? And why shouldn't I do the transaction? Well, do your homework on it. These investments do not last forever. And remember, the people that are presenting these investments are often there to get investors in as quick as possible to make sure that they can get their commission and move on and get their rate of return and get the project over, blah, blah, blah. So they're encouraging you to put their money in simply because, yes, it could be a good investment, but also they're going to get their commission on it. So what I mean by the whole thing, what I'm doing, and I'm sort of being negative Nelly, but I'm pressure testing it, is it's only when you understand these things should you be considering investing in anything. And talk to your financial planners. Like I said, this is just general information. It's not specific to what you're doing at the moment in your life. And you should be considering talking to someone in the expertise of investments and finding where these investment opportunities are. So realistically, the episode was to enhance property investors to have the courage and the foresight to do themselves a favour and actually start looking at other opportunities while the market is sort of somewhat sleepy. It's not getting their rate of return. And even if you don't end up investing or doing anything, but you start to research these ideas and talk to people who know about them, you're actually learning something. And that knowledge is never lost, right? And it doesn't mean you go out and start investing because you can. You're just learning. You see what I'm going with this? Because when our properties, as a property investor, when our properties don't perform as well as what we think they should be, or they're frustrating us, the best thing to do is distract our mind from actually making any rash decisions. And it's only through knowledge, and it's only through our in-depth putting a finger on the pulse on the economy that's going to enhance our ability to decide whether or not the investments or the decisions we make upon our investments are going to help us for the future. Now, we never have a crystal ball. So anyone that actually comes to you and say it's a sure opportunity, I don't think so. Like, I always err on the side of caution, as you probably already can tell, because I'm very skeptical. I've seen so many things go wrong. I've seen so many clients get burned, and I've seen so many times where I had to fix these things for my clients. And to me, it seems such a waste that if we are considering and our minds are continually thinking, what do I do with investments? How do I do it? Do I sell? Do I buy? Do I keep? Do I put the rent up? Do I renovate to increase the rent? What do I do here? Whilst your mind is racing doing this, what I would suggest to help your mind to stop racing, as what we call monkey mind, from branch to branch, thought to thought, it just continues to go down a rabbit hole. I would often think to say, start learning and researching about investments. Now, the unfortunate thing when it comes to researching on the internet is quite often anyone that pays money to put something up on the internet is a sell, okay? Yes, you need to buy before you can sell and sell before you buy, that sort of thing. You need that transaction, I understand that, but it's a common sell. So the first thing that pops up is a sell. I tend to be a bit of an old school investor, and I tend to have connections with people that I've known for many, many, many years that I can actually engage with to actually ask about investments. So what I tend to do is touch base with these investors appropriately at the time of what I think is going to be a good thing to invest in, and I speak to them, right? And then once I get the lowdown or the updates within the next 2 weeks or 2 months or 6 months, whatever's gone by, I then start to delegate and find out more. Even I have been investing for so many years, I still keep up to date with what's going on in the investment world. It's not just you learn it once and then you're done. Yes, the common fundamentals of investing can be learned, but this investment is always forever changing and you need to be updated, pretty much like the news. But unfortunately, the news only gives us a coverage of it. If you really want to make better money than what just the average returns are and what the news will present or sell to you on the day, I would always get an overall in-depth thing. Keep in touch with platforms that actually present opportunities, but really pressure test them once again. And anyone that's actually offering investment shouldn't be asking for money up front. They should be really more about not selling it to you, but demonstrating to you the return on investment. I think, everyone sort of tends to have an idea about what they can believe and what they can't. Is it a sell? Don't always go there with the mind that you think, you know what, I'm here to buy something, just sell me something. It's not like buying a car, guys. Investment's a very, 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 very important thing, and it should be regarded with the utmost responsible mind frame that you have at any given time. Once again, run it past your professionals, and this is only general advice, right? So, Google is great, whatever, looking on the internet is great for these investments, but once again, it always comes to human connection, I believe. There's too many frauds going on. There's too many platforms that you can just sort of literally log on to and you transfer money. Don't do it. There's got to be a human element behind everything. This place is not run by computers. Some people, yes, we say AI is taken over and blah, blah, blah. But when it comes to my money and investing in it, I'm not touching it. What I want to touch is something, especially as a property investor, something I can actually touch and invest in and allow my mind to be at ease, right? Because money is so hard to work for and earn, and I don't want to put it as a risk knowing that it could be lost only because of a scam going on the internet. Look, realistically, I could go on for hours about it. I'm not. But this episode was just to say to property investors, do your due diligence. Start to change your mind from worrying about your investment or knowing what to do, but start getting out there, not just on Google, but speak to people, speak to professionals, start making the call. Hey, all this sort of stuff. If it's often too good to be true, it often is. Speak to people that know about investing, speak to people that have been in the game, that sort of thing. Keep your mind at ease. And then if you find something out that you really are attracted to, you never know where it goes, right? So hope this episode helps. And please let me know if there's anything else that you think I should add to this episode or do another episode on. I'm more than happy to do it. Thanks, guys. All the best.